Who is that? Elizabeth, mute your mic, please. All right, so audit conclusion and audit reporting, training outline. So we are looking at what are those standards that relate to audit conclusion and reporting. All of these we'll be looking at is a 700, it's a 705, it's a 706, it's a 710, and it's a 720. Please take your time to go through all of these standards. We'll be having a brief talk around all of these as we go on. Then we'll look at meaning and elements of an audit report. So what are those things that actually makes up an audit report? What are the features that you should see in every audit report? When do we say we have issued a clean or modified audit report? What is a clean audit report and what is a modified audit report? What are the types of modified audit reports? We'll be looking at that. Management letter and summary review memorandum, we'll also be looking at that. Then management representation letter, what is this for? What is the correlation or the differences between management letter and representation letter? Then what are the subsequent events procedures? So what are the series of events that could occur even after audits that will warrant one action or the other to be taken by the auditor? So let's start with this. It's a 700. It's a 700 talks about forming an opinion and reporting on financial statements. Forming an opinion and reporting on financial statements. This is a 700. We can quickly relate this with ISA 200, which is the very first standard in the ISA series. And that talks about that, it talks about the purpose of an independent auditor in the conduct of an audit. In that standard, it was emphasized that the very reason why independent auditors were engaged is to offer what we call an opinion or express an opinion, but this opinion is not made by default. There are a series of activities that must have occurred. Certain due diligence must have been conducted. Proper planning must have been initiated. This planning must have been implemented with the intent of understanding the process of the auditees and obtaining valid evidences on the premise of which that opinion will be formed. So if you relate that standard with ISA 700, it's actually speaking to how you will, what will be the composition of your opinion. How will this opinion be formed? What are the contents that should be in your opinion and report such that we could be able to identify when we have put forward a substandard opinion? So auditors is required, or auditors are required to express opinion in auditors' reports. So among the audits, among the set of components of the audited financials is the audit report. So we know from what we have gathered at the beginning of this semester that auditors don't just review financial reports. They don't just review financial records. Those financial records are reviewed with the intention of forming an opinion. It is not the auditor's responsibility to preparing the financial statement. It is that of the management. What auditors are saddled with is come and review the process that gave rise to that report, review the internal control process that have been installed by the management to ensure that process that gave rise to the report are thorough and they are implemented in such a way that the output will be as valid as possible. So auditors are meant to review all of this after having had good understanding of the client's processes and say whether all is well. And if all is not well, identify whatever that is wrong. But whether you are affirming that all is well, or you are saying otherwise, your point or your opinion must be corroborated with evidences. So we have looked at what are those things that could pass the test of what we call or what we should call audit evidences. We've looked at the characteristics or the features of audit evidences before now. Now what we are looking at is how do we form the opinion and how do we report it? So one important thing to remember is that ISA 700 deals with a complete set of general purpose financial statements. So what is a general purpose financial statement? A general purpose financial statement is a financial statement that is not prepared to meet a specific need. No, it is prepared to meet the need of all the would-be users of the financial statement and not with the special purpose of financial statements. So sometimes clients may prepare some financial statement for internal use, but the set of financial statements that auditors are expected to review is that which is prepared with the intent of meeting all the needs of all the would-be users. So also it does not deal with the audit of particular financial statements out of complete sets or any particular component of financial statement. So where the management may want to validate other form of statements prepared for specific purpose, the process of validating that is not to be handled by external audits. What external audit concern itself with is those general purpose financial statements. And you as auditors, you need to bear these at the back of your mind, that we are not just reviewing any statements. We are not just reviewing any financial report, but we are reviewing those financial reports that are for general purpose. And what we mean by general purpose is that it is not actually prepared for a particular party. No, it is prepared for parties that may, whether now or in the future, whether within the company or outside the company, whether spread across the national boundary where the company is resident or beyond that geographical territory, those who may have any form of need of the financial statements of the organization are those whom these financial statements are prepared. That is what, that is the interest of those whom the auditors are prepared or reviewing these reports for. So take that at the back, bear that at the back of your mind. Then forming an opinion, still on ISA 700. The auditor's opinion on general purpose financial statements is as if they are prepared in all material respects, in accordance with the applicable financial reports. So eventually, we considered both in our audit class and our financial reporting class that the audit process are teleguided by regulatory frameworks. There are frameworks or law, conceptual or standard-wise, legal or regulatory-wise, that guides how auditors should do their work. In the same manner, there are there are frameworks that guide how financial reporting should be prepared. So auditors are expected to understanding not only the framework that regulates how audit process should be done, but also should have a fair understanding on how the financial reporting process on which they are reviewing should also be carried out. So You cannot form a fair opinion or an independent opinion if you don't even understand how financial process or reports and the framework that should regulate it are to be implemented. So you should have a fair understanding of not only your audit process framework, but also the financial reporting framework. But before auditors is able to express an opinion, he is required to gather sufficient appropriate audit evidence, as only sufficient appropriate evidence reduces the risk to an acceptable low level. So this is exactly what we are saying. We review or independently examine the financial records with one intent, to make an opinion. But in making this opinion, we must be sure that sufficient evidence has been gathered, and those evidences are not only sufficient, but they are also appropriate for the form and the intent that we seek to achieve, right? And we have looked at what are those things that meet the definition of sufficiency, and what are those things that meet the definition of appropriateness in our previous class. So we won't waste time on that. Then audit risk is gathered to have reduced and to an appropriate level if auditors has obtained. Usman, please mute your mic.
Sorry.
All right, so one of those things that could throw us off balance or that could invalidate as insufficiently and inappropriately gathered evidences is what we call an audit risk. You remember that an audit risk is a risk that the auditor will make an inappropriate opinion or conclusion on any audit process. So diligent planning has to be done to ensure that these risks of audits are as minimal as possible. Now, to conclude that reasonable assurance has been obtained, auditors shall consider the following. How would you be sure that you have passed the test of reasonability? You must ensure that all the following dots are ticked. One. John, Ayomide, mute your mic, please. John, mute your mic, please. Then if sufficient, that is the number one. If sufficient appropriate audit evidence have been obtained, so you need to answer the question. Have you sufficiently and appropriately gathered enough evidences that could serve as a basis for your reasonable confidence you want to instill? Two, whether uncorrected misstatements are material, individually or in aggregate, and appropriate steps have been taken. So oftentimes there are instances that in the course of your audits, you raise some exceptions. Ezekiel, please mute your mic. You raise some exceptions, okay, and you are not able to reach a consensus with the client. So if the client is at the opposite end or is of an opposite opinion, that those things that you have flagged are not convincing for them, they are not willing to take into that correction, how do you address this? So this is speaking to that whether uncorrected misstatements are material. So if they are material, then you might be thinking that you probably may be issuing what we call a modified opinion. So there are processes to confirming that. But I want to make this, this section as constructive and practically insightful as possible. I'm aware that a number of people are working in audit firm or in practice as we speak. Is Adeni here? Adeni, please signify if you are here. Grace, signify if you are here.
I'm here.
Yeah, I would need your input on this. I just raised an issue, one of those dots that needs to be cleared before you can be sure that you have cleared all doubts and your opinion is as reliable as possible. So I'm referring to this number 2. Whether uncorrected restatements are material individually or in aggregate, an appropriate step have been taken. So what I want to confirm from you, have you in the course of your audit engagements had instances where you raise an issue in the audited accounts, I mean in the financial statements, and the management disagree with it, and they are not willing to take into the suggested manner of correction? Have you had anything of such?
I am working currently with one. Just
sorry? You are far from your mouthpiece.
Oh, sorry. I'm using external speaker. So I'm currently working on one. We have submitted our observations. We are just waiting for their reply. So we don't know whether they will disagree or not until we get their reply. Other ones we have done in the past, we raise our observation where necessary, where we discover contravention to compliances and other things. So, and we have been educating them, even when they do not know that this is the right thing to be done, so that we can be truthful when we say account conforms with relevant standards. I don't know whether I get what I'm saying.
Yeah, I do. But do you have any particular one that you raise exception, whether contravention to the standard or any regulatory compliance, and the client objects that no, it is not so? Have you had anyone?
Not yet.
Okay. Let me engage any other person. Thank you for your contribution. I wanted to bring out the points there, because if you had one, or in future if you have one, this second point is speaking to what you need to do to resolving it. There are instances where the client will say, no, I don't agree. And they will be arguing with you. And if you listen to them very well, some of the points they might be raising may be technically correct, right? But it may, in your opinion as the auditor, you also don't agree with it, right? So let me ask another person whether anyone, or let me throw it open, who has in the course of their work as auditors has or experienced instances where audit exceptions are raised and the client objected to it. How do you eventually resolve it? Raymond, do you have any?
Good evening, sir.
Good evening.
Yes, I have one.
Okay, so what, can you give us a brief without mentioning the name of the client? Give us a brief and what you did in eventually resolving the issue.
Okay, during the course of our assignment, we realized that some of the expenditure were actually on household. That is, the directors, they fund their household expenditure using the office. Like Netflix, they will subscribe Netflix for the director's wife. They will raise an invoice for it. They will pay electricity for the director home. They will put it in the office expenditure, and it accumulated to millions. So we actually raised that, and we discussed with the management that they should remove it from the office expenditure, the business expenditure. But at the end, the director refused that it is his business, though he has the highest controlling share in the business. So at the end of the day, we just put it in our management letter because he was not actually giving us any reasonable excuses for us to understand with him. We just put it in the management letter. That was how we were able to resolve it.
Okay, okay, that is a very, very good one. Thank you very much. So in future, when you have that kind of engagement, these are what you should do. It is not out of place for those who are in a senior position or even in a directorship capacity to incur some personal expenses, and it will be on the books of the company. It is not out of place, right? There are some instances that it will be out of place. But what you as auditor should do is any position that is being taken, unfortunately too, that very concern you raised, unfortunately, there is also no specific standard that provides how that should be addressed. So what you should do as auditors is where those things are taken, are treated in that way, the organization is expected to put up an offer letter or a contract of engagement, appointing those auditors, appointing those directors and specifying clearly what their benefits and other consideration will be. So those benefits in terms of other home expenses or personal expenses of it, if it has been specified in the contract of engagement, yes, you will have no other option for it to be reported as expenses relating to the directors, right? So that's one consideration you need to take. So what this point is speaking to now is that, yes, there is an uncorrected misstatement. So you need to now assess it. Is it material individually? If it is material individually or in aggregates, you might need to consider whether that misstatement will inform or should inform qualifying the account or modifying the account as the case may be, right? So I'm sure why one of your partners or the partners in charge So while in aggregate, while those decisions, I expect that the partner will have looked at it that this particular expense, why it was overlooked is that it would not have in any way misrepresented the financial statement. Those expenses were legitimately incurred. Is that taken? Because those expenses were legitimately incurred, it may not be interpreted as being a materially misstating the position of the company. The company actually incurred those expenses, right? So that is the position of it. But you need to look at other issues that could creep up in future, whether if you don't, they don't take to the proposed correction or restatement, whether it will affect the position or the outlook of the financial statement. Other things that could affect the position is, say, for example, they did not incur an expenses and it is huge in value and they want to report it, or they incur an expenses, a capital expenses, they want to write it off as a recurrent expenses or a current expense, or they have incurred a qualifying correct expenses and they want to capitalize it. So these are some of the issues you probably might need to consider whether we will be misinforming the public by accepting that position. 1 minute, please. Hello, are you there?
Yes, sir.
Yes, sir.
All right, so I believe you got my point on whether uncorrected misstatements are material individually or in aggregate. An appropriate step have been taken. So the appropriate step would be looking at those expenses. Do they actually constitute material misstatement? The contribution that Raymond shared is a valid point. But if you look at it, whether directly or indirectly, it is an expenses that was incurred. So the only problem was that whether it should be a business expense or it should not be a business expense. And why I think the position of the director is not far from being correct is that as a director of a company, right, there are some of my domestic expenses that the company should be able to foot. Because even while I'm at home, I'm still doing the company's work. When I listen to some of when I use the DSTV or whatever, there might be some practical insights that will be that will enhance my job delivery. Do you understand? Because I listen to news and all of that. It is not really because I want to listen to news. I'm being very vigilant enough to be sure that I'm protecting the business interest at every point in time. So this is applicable to most people that occupies a senior role. So even where they live should be a reflection of what the status of the company or where the company is projecting to. So some of these people don't have a personal choice of curtailing some of these expenses. And that is why you see that in some organization, when you get to certain status, they will specify the kind of car you should drive and the kind of places you can live. So this form of expenses should be at the cost of the organization. So I don't think that is really out of play, but it's a very valid point. Thank you very much, Mr. Raymond.
Yes, sir.
To everyone, I think I want to assume that you understand the points that we have raised and how that could be addressed in here.
We understand, sir. Can I raise the question, please?
Yes, sir.
Yeah.
What Raymond just opened our eyes to, can we qualify the account, the report, because of that?
Okay. What should give, the processes of qualification of account is even more thorough, more rigorous than how people even look at it. But the underlying facts, we are still coming to that, of what could happen before we could qualify an account. But why I don't think it is a qualification factor is this. Was the expenses incurred, whether personally or for the business? Was it incurred? The answer is yes. Raymond, can you speak to that? Was the expense actually incurred?
Yes, sir. Yes, sir. The expenses were actually incurred.
That is number one, that it's a valid expenses. The bone of contention is incurred for who? If it were to be incurred for the security or incurred for cleaner, I will dispute it, right? But it is incurred on the director. Director, you know, they bear the face of the company, right? Look at, let's even take it outside the business. Let's look at the political space. There is a noise from somebody's background. Who is using Nokia 2.3? Please mute your mic. All right, let's look at the political space. Mr. Governor of any state in Nigeria or Mr. President, if you had asked them, they probably will want to live as a common man. Some of them, if not for security concern, they will want to continue to govern and perform their political functions even from the former places where they live. But the standard is, if you are in this level or at this level, you cannot live here. So as part of their benefits is the state or the country will provide a place of abode. If you look at the consideration given to these people and the expected standard of life they want them to live, even their consideration cannot, if they don't steal money, cannot finance that lifestyle. Same with the director. Do you understand? So that is the objective perspective I'm looking at it. So it's a valid business expenses. But where I can raise concern on them is if they now say those electricity, they merge it or report it alongside with the business electricity. No, it should be reported as the director's costs. Adeni, do you get me? Hello? Is Adeni and Raymond there?
Hello, sir. Sorry, sir. I am trying to unmute my mic. I always mute it. Okay. I always delete my response. I get your point.
Yeah, so there could be a classification issue, which you will have to take your point that, take your stand that, oh, these expenses have been incurred this way. Yes, we agree. And it is being incurred because the directors are serving directors. There are some organizations that will even bear some other personal expenses of their director in terms of their family expenses. For their wife, they will pay them certain allowances, they will pay their children's school fees. It's still part of the business costs, as long as that director is a serving director. But if they now classify all of those expenses, categorize it as part of the regular business electricity, that is what is wrong. Because with that one, you are misinforming the public. So anybody picking the account should be able to tell what is the total cost you have incurred on the directors. I hope that is taken. So then secondly, it is not a basis for qualifying the account. It is a very valid expenses, right? So what they just need to do is to reclassify and report it very well. Let whoever that picks the accounts be able to say that, yes, this total expenses was incurred by the company, but these are the Corley business expenses. These are the Corley director's expenses. I hope that is clear.
Yes, sir. So right. I have a question in this regard.
Okay.
The director expenses, like for example, if you pay school fees from the company account, when you are computing his personal income tax, are you going to add that as gross income?
Technically, yes. Technically, okay. Yes. It's part of the other benefits.
Okay.
It's part of the other benefits. It is taxable in its hands.
Okay.
Yeah. Grace, are you saying speaking to this, or it's or you are distracting us? All right. So the third point is the results of evaluation in which the auditor is required to evaluate. What are those things that the auditors are expected to evaluate? One, whether financial statements are prepared in accordance with the applicable financial reporting framework by evaluating if significant policy are selected and applied, selected and applied are adequately disclosed. Yes, so you need to pay attention to that. All of their accounting policy or the significant policy they have adopted, do they disclose it? If no, you need to insist that it must be disclosed. Then accounting policies so selected and applied are consistent framework requirements. So those significant policies that they have selected and applied must be in line with what our framework requires, our conceptual framework requires. Where there are deviations from those conceptual frameworks and the relevant provision in those standards, they should be able to state that this is why we are deviating, and the deviation is expected to enhance fairness and truthfulness of the financial statement being presented. Then the third one is that management estimates are reasonable. So in instances where they need to make estimates in terms of depreciation estimates and other forms of valuations, right? It must pass the reasonability test. Then the fourth one is that financial statement fulfills qualitative requirements, right? Those qualitative requirements of every financial statement must be passed. That is in line with IAS 1. So it must pass the relevance test. Those disclosure bearing must be relevant to the business of the company. Reliability test. Information that have been disclosed there should be that which it can be depended upon. Understandability test. Sorry, there is a disruption there. Can you see my screen? Hello, can you see my screen?
Yes, sir. Yes, sir.
Yes, sir.
Yeah, understandability test. It must also pass the test of understandability. It must be communicated in the way that the would-be users can read it and understand it. Understandability is looking at the language of communication.
Sorry, I can't see the understandability. Okay, sorry, I can see it now, sorry.
So understandability test, is it communicated in the language that everybody can read and understand? Not that you are reporting a financial in Nigeria and you are communicating it in Chinese language. People will not be able to understand it, right? Then comparability test. If the financials that is being audited is not the first year financial statement, then it should have comparative figures, right? So those are part of the qualitative test that the financial statement must pass. Another one is the timeliness. Timeliness, it must be made available when or within the time frame that it is expected of it, right? So all these tests, you need to look at them and be sure that they are well passed before you can issue a clean report. Then the next one is adequate disclosures accompany financial statements so that users can understand the effect of the material transactions. So this is a very important point. Can we differentiate between presentations? What do we mean by presentations in the financial statement, and how is it different from disclosures? You will observe that when we are going through any standard, particularly the accounting standard, it will always emphasize presentation requirements and disclosure requirements, right? What is the presentation requirement speaking to, or what does it mean? And what is disclosure requirement speaking to? Who can answer that? Adeni, can you try?
Again, sir.
Again, sir.
What is the difference between disclosures and presentation in financial reporting?
Presentation has to do with the way we present the financial statement, the income, the cost of direct cost, and the rest. Presentation, account normally. Disclosure has to do with information that will be included in the financial statement.
Very correct. Very correct. So presentation is speaking to all the numeric reports. What are the composition of your statement of financial position? What are the composition of your statement of profit or loss? What are the composition of your statement of changes in equity? What are the composition of your statement of cash flows and all of that? But disclosures is providing narratives. It's providing narratives to how those summarized figures in those statements were arrived at. Please take note of that. So what this fifth point is speaking to is that adequate explanations or narratives accompanies the financial statements so that users can understand the effect of the material transactions. I hope that is clear. Then the next one is that terminologies used, including titles of financial statements, is appropriate, right? So we need to be sure that where you are presenting the balance sheet, you are not calling it statement of profit or loss. When you are presenting the statement of cash flow, you are not calling it statement of value added and all of that. So the title used in those financial statements are not only correct, but they are appropriate for that purpose, right? Then another thing is that we should be able to clear the dots on appropriateness of financial statement, considering the qualitative aspect of the entity's accounting process, then the probability of distortion of the financial statement due to management's bias. So we must be sure that the biasness or the self-interest of the management will not distort the true and the fair positions of the financial statement. So you should be able to separate selfish interest or self-centeredness of the management on how certain things are, or the purpose for which those presentations are made in that way. Is it because the management wants to achieve certain intention, or because that is a fair or the most fairest way of making those presentations? Then whether applicable financial reporting framework have been appropriately referred to or described. It is one thing for you to have prepared your financial statement in line with the framework. It's another thing for you to have referenced it appropriately. So there is a section in the financial statement where you will say, these financial statements have been prepared in line with the appropriate standards, say IFRS and the likes. So if you have prepared your financial statement in line with NGAAP, and you are now making disclosures that, oh, you have prepared it in line with IFRS, then there is disjoint in your position. So you need to be sure that those narratives they are providing subsequently is in consonance with the actual financial reporting framework that have been deployed. I hope that is clear. Then still on, it's a 700 forms of opinion. The auditor shall express an unmodified opinion if, so we have modified and unmodified, shall present an unmodified opinion if auditors concludes that the financial statements are prepared in all material respects in accordance with the applicable financial reporting framework, or in other words, that financial statements are giving true or gives true and fair view of the business. The auditor shall give modified opinion. So you've seen where auditors can give unmodified opinion. The regular and the expected opinion to be issued is the unmodified opinion. That is a clean report, right? But where contraventions that we have earlier considered before have been made, right? And you have looked at it beyond reasonable doubt, you can conclude that these contraventions that were made will have materially misstated the true and fair positions of the company. Then it is advisable for you to what? Modify the report. Oluwatobi, please mute your mic. I know, please mute your mic. All right, so what then happens, or what are those things that could occur before we consider modifying the opinion? One, that audit evidence obtained makes the auditor to conclude that financial statements are not free from material misstatements. Or auditors is unable to obtain sufficient evidence or appropriate audit evidence whether the financial statements are free from material misstatements. So there are instances where you actually see and you can corroborate that, oh, all these disclosures made, they were actually wrong and they are materially misstated. And there are positions where you could feel that something is wrong, but you've not been able to obtain sufficient evidences that they were actually wrong. So you need to take note of that. So we have unmodified opinion and we have modified opinion. Unmodified opinion are the regular opinion auditors should provide or make where you have been able to dot all lines that all is well. There are no reasons that will make you conclude that there are indications of unfairness or untruthfulness in the presentation made, that the financial statement prepared is in consonance with what the conceptual framework provides. There are no contraventions in the applications of that application of the relevant accounting standard to the preparation of that statement in line or in contravention with what the standard actually provides. So if you've been able to see that all has been done in line and you have obtained your evidences, what you will issue is an unmodified opinion. But where you have reasons to believe, whether with concrete evidence or your instinct tells you that, oh, all is not well, but you've not been able to obtain sufficient evidences to corroborate that, you may consider modifying the opinion. Any question on that? Adeni, I believe I've been able to speak to your question.
You have done that, sir.
All right. So still on ISA 700, what is then the content of the auditor's reports, which is unmodified? The content of auditor's reports, which is unmodified. The content of auditor's reports, which is modified, will be different from that which is unmodified. So where we have unmodified, auditors express his opinion on entities' financial statements in the form of a written report. So it is not oral, right? It is not oral. It must be documented. It must be written. As auditors expression enhance the credibility of financial statements, therefore, auditors' report follows a certain format and comprises of specific elements and content. So people are watching out for that very page of the audited account that actually speak or expresses the mind or the opinion of the auditor. So we need to be diligent and be careful in confirming that what we have disclosed therein and the evidence we have obtained actually are in consonance with our positions and our findings. So what are those things you should see when you see an unmodified opinion? So, however, as per ISA 700, auditor's report has the following elements. One, there must be a title, right? There must be a title. Okay.
So my question is on the modified audit report.
Go ahead.
So far, you hardly see in practice Why is it that so far you hardly see in practice where auditor give a modified audit opinion? That's number one. Number two, if truly they are giving a modified audit report in practice, why is it the government are not doing anything? Because I know accounts of ministry, department, and agencies, they are being audited on a regular or on a yearly basis. Are they not giving this opinion, or this opinion is just on a theoretical basis? Because oftentimes, almost all financial statements that I have prepared so far, there has never been any case that we give a modified audit opinion. So I'm worried. I don't know.
Okay, the first question I will want to ask you back is, in all the accounts that you have prepared,
yes, sir,
have you seen or experienced instances where legitimately there are reasons to have qualified the account?
Yes.
Without mentioning the entity or the organization, can you share some of those things that you think were wrong and should have necessitated the qualification of the account?
Okay. Number one, I have seen instances where the directors of a company, they use the companies, they withdrew money from the company into millions, and they will tell you, will ask for evidence. They will tell you there's none. Just use your judgment. And sometimes you will see that they use such amount of money in buying maybe cars for their girlfriend. Apart from buying cars from their girlfriend, there's some money that they cannot even account for. They will tell you, don't go there. They will transfer money to some companies. You ask them, what is this money meant for? They will say, just forget about that one. Just do as we tell you. I don't know if this reason is not enough.
Yeah, there are cogent reasons, right? But I believe that I don't know the position you are taking during the time you are having those audits, but I want to believe that I'm just trying to be very objective now.
Yes,
I want to believe that the partners in charge of those engagements would have looked at those exceptions and maybe in their opinion, because there is no general standard on what should be done or what should not be done. What the standard only provides is that those areas that we should do. And if the partners in charge who is taking responsibility for those audits don't see those things as convincing enough to have qualified the account will not be qualified. However, where there are instances to qualifying the account, it is not a final decision that the auditors has to make. When auditors find any reason to qualifying the account, it is expected that those accounts, before qualifying it has to be shared with the FRCN. The FRCN will have to sit over it because qualification of account is a very, very serious case. And if you are very much abreast of the developments in this practice, there was a bank, I don't want to mention the name of the bank. Sometimes I think about 4 or 5 years ago, that despite the fact that the auditor did not qualify the accounts, FRCN still pick on that very entity and find reasons why that account should have been qualified. And they insisted that the qualification has to be made, and there were sanctions. The sanctions were even as far as suspending their trading, the trading of their shares on the stock exchange market. So in Nigeria, despite the laxity in our system, where there are serious reasons, objective reasons, not subjective, objective reasons why an account should be qualified. I don't think our practice has lost that much integrity to have let those things overlook. Governments are not directly responsible in doing that. There are delegated authorities, those who should actually perform those obligations on behalf of the government. That is why ICANN from day to day is expected not to just conduct exams for aspiring accountants, but also supervise and checkmate the shortcomings in practice among professionals. That is also why the FRCN is there. FRCN is not only saddled with the responsibility of issuing accounting standards, no. Part of this responsibility is to, in conjunction with ICANN, also checkmate the laxities among professionals in practice and be able to make corrections where necessary. So I believe if any case is being very trivial enough and the auditor is convinced enough, those accounts should be qualified. Even in my 15 years working experience, there has only been one case or one account that beyond reasonable doubt, I resolved. I was a partner on that very engagement and I insist that the account must be qualified and it was qualified. Then second thing is also that what also determines the triviality of that of each case is whether the company is quoted or is a private company, right? If it's a quoted company, the committedness and the diligence is more thorough because there are more risks in not qualifying or disclosing what needs to have been disclosed, right? The sanctions are more evident. So that is why you also see that when you have auditors that audit clients or entities that their shares are quoted on the stock exchange market, right? There is thorough scrutiny even after the account must have been signed and submitted. Those entities also that are regulated, particularly those in the finance, banking and other finance sector, that is why you see that before the accounts are eventually publicized, it must be submitted to the regulator. The regulator will scrutinize it, and if they find anything so fishy, they will return it that corrections should be made before publications are made. So I need also be very, very open. There are some things that may appear very trivial, but because the level of judgment that is expected of the partner in charge, if the partner is not convinced enough that these things were around qualifications or reasons to modifying the account, he may choose not to. But where they ought to do and they don't do, whether today or tomorrow, the risk is there. If eventually issues come up and they were found to have been complacent, of course, sanctions will be given. Raymond, does that answer your question?
Yes, sir. Yes, sir, to an extent. But, you know, what I'm talking about is based on being practical, what is being obtainable on the field. Like when I raised the issue with my boss, the answer he gave to me is that if you do anyhow, they will not call you again next year.
Okay, so
the answer he gave to me.
You know that is a different issue now.
Okay.
And already it is very clear that there is an audit risk. And that company or that firm is acting at its own peril. And that was why I said it in my earlier statement, that it is a judgment that needs to be made by the partner in charge. If you think that he's willing to take in that risk for doing what is wrong, every day is for the thief, one day is for the owner. The license will be at risk, the punishments will be there, right? But the rule is there for every reasonable and responsible accountant to follow it, right? So if you choose to go through the wrong path and do the wrong thing because you want to preserve your engagement, it is at your own peril. We have considered a number of topics that speak to that before. I'm sure you know. So you should be able to take your stand and be able to decide that in whose interest are you working. I understand the state of dilemma you might be wanting to preserving the job, but sometimes you need to compare the risks of preserving your current job with the risks of putting the license at stake and the reputation of the profession at stake too, right? I can't hide away from the fact that some people may be doing that. That is one of those reasons why we even put up this particular section, because we saw a lot of deficiency in the expected proficiency of people, right? Particularly the upcoming accountants, right? This set of people, the people on this platform now, in another 5-10 years, most of you will own your firm. Most of you will take CFO or very senior positions. Very many of you will even own your various businesses. So if you have been wrongly trained, it will affect the reputation and the expected deliverables, right? So we cannot hide away from the fact, not only limited to Nigeria, but every other part of the world, that people make that decision. If there have not been issues like that, there would not have been a deliberate provisions in the ethics and in the standard of how accountants and auditors are expected to behave, right? Does that answer you? Raymond.
Yes, sir. Yes, sir.
Yeah.
Thank you, sir.
So what we need to ensure is that as professionals in practice, particularly where we are directly responsible, we need to be able to strike a balance between you want to be considerate and you want to preserve your job. There are instances that you need to speak the fact, right? But weigh both options and be willing to take in the one that you think will protect the profession first, preserve the country, and actually preserve your own interests too. But among all those cadre of options, your interest should be the least, right? If you're doing anything because you just want to make the money now, there might be a problem in future. I'm sure we have also considered a case, the Aaron case. It's something similar to that. That it has not happened visibly in Nigeria doesn't mean it can still not happen. So we need to start doing the right thing now to avoid being in such similar mess. All right, so back to what we are discussing. Oh, we have wasted so much time. So what are those composition or components or elements of the audit report? First of all, there should be title. Auditor's reports must be a clear title that indicates that it is a report from an auditor. For example, you will see things like independent auditor's report. Inclusion of the title supplement the fact that it is a report from auditors who is qualified as per the Code of Ethics and applicable laws and regulations, right? So you need to take note of that. The second thing is the addressees. So there should be, that report should be addressed to certain parties. So the addressees are the evidence, are the audience, I meant to say, to whom report is meant to serve. However, it should be stressed that they are not the only users of the financial statement. So further, for example, the shareholders, but addresses may vary from situation to situation and must be mentioned in the report. So the appropriate addressee will be who are those that actually engage the auditor. If it is the shareholders that engage the auditor, of course, the report will be addressed to the shareholders or those saddled with that responsibility. So we've mentioned the title, we've mentioned the addressee. The next one is the introductory paragraph. So this paragraph conveys some basic yet important facts regarding the financial statement, which are: one, the name of the entities whose financial statements are audited; two, clear statements that financial statements are to be audited. 3, title of the financial statement that comprises complete set of financial statements. 4, summary of important policies and other explanatory information which may or may not form part of the complete set of the financial statement. 5, clearly mentioning the time period covered by the financial statement that is being audited. So if you pick up any financial statement, any audited statement after today, consciously and deliberately look out for these things and be sure that they are there. If it is done as it ought to be done, because this is the prescriptions of the standard, and any auditor working on such similar engagements should ensure that they have conformed with the relevant provisions in the standards. If there will be need for deviation, they are expected to specify clearly that this is the reason why they have deviated, these are the areas of deviations, and these are the intention of the deviation. Any question? Any question?
No questions, sir.
All right. So we've talked about the title, we've talked about the addressee, we've talked about the introductory paragraph. Next one is the basis of the opinion. The auditor's report shall include a section directly following the opinion section with the heading basis of opinion. The basis of opinion states that the audit was conducted in accordance with the international standards on auditing. So look at these affirmations you are making. You are saying that you have done the audit as the auditor in line with all the ESAs, right? Therefore, before you make this affirmation, you must be sure that you have a fair understanding of those ESAs. Don't say you have done the things that you have actually not done, because it could actually pose a problem in future. Ignorance is not an excuse, and that is why we continue to emphasize that as auditors in practice, you should have a sound and good working knowledge of the relevant provision of these standards and amendments made on them from time to time. So in accordance with the ESAs, refers to the sections of the auditor's report that describes that the auditor's responsibility include a statement that the auditor is independent of the entity in accordance with the relevant ethical requirements relating to the audit, and has fulfilled all the auditor's other ethical responsibility, and shall state whether the auditors believe that the audit evidence that the auditor has obtained is sufficient and appropriate to provide a basis for the auditor's opinion. If the audit evidences you have obtained is not sufficient and it's not appropriate, then you may think you need to disclose it, then you may consider qualifying the opinion. Then it also must speak to the going concern. There should be a section that talks about the going concern. What measures have you taken? Are you sure that that very organization will be in existence in the next visible period, which is at least the next 12 months? So where applicable, the auditor shall report the going concern of the entity. So if the entity is having some going concern threat, you need to state those going concern threat that you have identified that the company may not be in existence in the next 12 months, and these are the indicators or the reasons or instances that gave rise to that. Then key audit matters. The auditor shall communicate key audit matters in the auditor's report in accordance with ISA 701. So when we get to ISA 701, I will be speaking more to that. Then other information where applicable. Where applicable, the auditors shall report in accordance with ISA 720. So we'll speak to that too. What are those things that will give rise to other information that auditor may speak to in the course of the audit? The responsibility of the financial statement, for the financial statement rather, who has or owns the responsibility to doing that? Then the auditor's report shall include a section with an heading, responsibility of the management for the financial. So the auditor's report shall use the term that is appropriate in the context of the legal framework, in particular jurisdictions, and need not refer specifically to management. So in some jurisdictions, the appropriate reference may be to those charged with the responsibility or with governance. So not in all cases that the management may be held responsible for the preparation of this financial statement. Some other jurisdictions may say this will be the responsibility of those that are in charge of governance. So any question on that before I go on? Any question?
Hello, sir.
Yeah.
I want to ask, for instance, you have an assignment, audit assignment, whereby the firm is well registered, but the structure are not formal. Only that a need arises.
Sorry, take that again. Take that again.
All right. We have an audit assignment. The company is registered with CAC. But the structure is not formal, one-man business. They don't see compliance as anything, but a need arises that warrants the company to request for auditor's reports. I don't know whether you get what I'm saying. Even the company does not have an accountant to prepare the accounts for the auditor to audit. They engage the auditor for accounting services and the audit. I don't know whether you get the point.
I do.
Number one question, is it allowed for the auditor to do accounting services and audits? Number two, if it is not allowed, but auditor goes ahead to do the two, who do we state in our audit report that prepares the account?
Okay, so I will not shy away from the fact that this is very prevalent in our society today. As there are very many organizations, particularly the SMEs,
all right,
even though CAMA provide explicitly that the financial reporting and the necessary controls is the responsibility of the management, right? But you will also agree with me that management will only discharge this responsibility where they actually have the skill set to do so. Sometimes they may delegate these responsibilities, but delegating that responsibility does not absolve them. Delegating that duty, I mean to say, does not absolve them from taking responsibility for the rise and fall of whether that particular duties were rightly done or otherwise. Do you understand? So my second point is, do auditors or do some auditors do this? True be told, yes. But the standard is also clear that where auditors wishes to offer some other non-audit services, because the accounting function is not an audit service. Where the auditors choose or in some instances offers non-audit services, there must be an assessment of the risk involved, and measures or steps must be taken to hedging such risk, right? So one of those measures that is provided in the standard is that there must be, you can introduce something we call Chinese wall. Chinese wall means now that you have dedicated team that are under different partners' supervisions, right? And what they are doing is strictly that non-audit service alone. And there must not be interferences or sharing of information between particularly information that should not be shared between the non-audit service team and the audit service team. So if you check most of the Big Fours, they do accounting services, but these accounting services are not done by the same audit team. The accounting services or other non-audit functions are done directly, are rendered directly to the company, and the management is well informed that it is their responsibility. So actually standing to whatsoever rise and fall that may come out of it. But where auditors may be held liable is if the same person handles the accounting service and that same person handles the audit service. The problem there is, will there be sufficient internal checks and control, or QC, to be sure that there are no embedded errors? The chance that there will be inherent errors will be high, right? The chance there will be familiarity threats is high. The chance there will be self-detection risks will be what? High. Do you understand? So if you have in any firm that has identified those possible shortfalls and have built framework that will mitigate the occurrence of those pertinent problems, it is not out of place to doing that. It is not only the small firms that are doing, even the Big Fours are doing that. Check with some of your peers in the Big Fours. Some of them, and very many of them, are in departments that renders non-audit services functions. They can call it various names, but their functions are not core audit service. However, when you want to take up an engagement, you need to make this point very clear to your auditee or your client. Let them know it is different functions. Let them know that those functions relating to financial reporting is their own direct responsibility, right? But where you could see that you will not, or you don't have sufficient control to guarantee those measures expected of the standard, please, you may consider not taking up the engagement, right? But if you have built measures, right, in the system that will enable you to be able to render that services, of course you can do it. And if you need more information about how to implement such structures, because we have such structures in KCP, we have dedicated team who does not interfere with the audit process. So those team are independently supervised, and they handle accounting functions for the clients. While dedicated team who are under different supervisions may also render services to the same client, but there are no interferences, right? But I cannot also hide the fact that there are occasions that we appraise the risks and we don't have measures enough to mitigate those risks. Those engagements we don't take at all. But the ones that are present controls and Chinese wall installed already can actually mitigate those concerns. Of course, we will take up such engagements. Does that answer your questions? Hello, Adeni, are you still there? Adeni, can we go on? Have your question been answered? Well, I don't know, when you are better positioned, you can confirm, but if not, still ask further so that we can clarify. All right, so on to everybody, please, is there still any other question before we go?
Good evening, sir.
Yeah, good evening.
Please, as regard to what he asked earlier, is there any standard backing that up?
Is there any standard backing which one up?
Okay. Like he said that it's still right for an auditor to prepare an account for a client and at the same time audit it.
Yes.
Okay. What's the standard, please?
There is a standard that takes care of non-audit functions. When you are rendering any audit functions that are not external audit functions, right? What you use is Israel. It depends on the very, accounting service is not the only non-audit functions you render to clients, right? One of those non-audit functions is also tax services. Do you understand? One of those other non-audit functions could be review engagement alone, right? So the type of the audit functions will actually inform the appropriate standards to deploy. But one of those other standards that is being applicable is Israel, ISRE, International Standards on Review Engagement. Are you there? Does that, hello?
Yes, I'm here. I'm with you.
Yeah. So that is one of those standards that you can actually deploy. Yes, Israel. So maybe much more later on, that very topical issue can be one of those things we'll bring up in our next episode so that we can speak very well to that. But it's not out of place for you to do. But you just have to be sure that you have been able to deploy sufficient and diligent controls, right? That will guarantee the honesty and the fairness of the report that will come out of that. What I did not support is, which most small firms does, is one single person will prepare the financial statement. That same single person or the team will prepare the audited account. It is entirely wrong. There is no how you can guarantee that the output from that account will be free from error. Do you understand? Firms that does that is not doing it in the right way. But organizations that have installed what we call the Chinese wall, we have independent teams that are not subject to the control of the audit team under different supervision, that their function is purely accounting functions or tax function. They don't do any other thing outside that, right? But where you have the same team that handles tax, the same team that handles audit, the same team that handles accounting function, then you cannot guarantee that there won't be errors, other delinquencies within the system. That is wrong. Mr. Timothy, does that answer you? If you want further information, you can still speak to me. We can take it off from there.
Yeah, yes, thank you. Because we'll face this most time. I think there is, like he said earlier, I also said so the team lead there, I need to have, okay, fine, we preparing this account because the client doesn't have an accountant. Though at the end of the audit exercise, we recommend one for him, telling him to at least try to employ one accountant to be doing that. Anyway, that it will be a trend for us to prepare the next accounting year, that she try to involve one accountant so that to hasten the preparation of the account. But yes, like you said, I still want to clarify, but since you have told me this, I would like to go through that standard to see further clarification as regard to that. Thank you.
Of course, of course. But note, if you manage a firm at the moment and you want to implement such that, it means the implication is that you will have to first of all look at your present structure, can it accommodate that, right? 2, do you have the supervision resources? Because it's always very expensive to maintain that kind of structure. That is why you could see that ideally those bigger firms that maintains that is more expensive. But at the beginning of every engagement, it is not all engagements that you take that even though you have the in-house resources to handle it and there will not be interferences, it is not every engagement that you will take, because if you have appraised your risk and you see that your opinion may not be fair, you probably may need to do away from that engagement. It's either you will choose taking one and leaving the other. Do you understand? So as auditors, before you take up any engagement, no matter how juicy they might appear, you will definitely have to appraise your risks before you taking that decision. But if you have appraised your risks, and the purpose for doing this should not be driven by money. No, it's not because of what the client is paying you. It's because of the fact that you have resources that are under independent controls and management to be able to deploy in that. So if you have that, of course you can do. But if you are in any way not sure that your present structure can accommodate that, please don't do, so that you don't put the firm in a mess. But we can take up that discussion much more later on after this class.
Okay, thank you, sir.
All right. Any other question before we go on? Hello, if there is no other question, please just affirm so that we can continue from there.
No questions now.
All right. So it's already 7:57 now, and we have to stop this class by 8 o'clock. So we'll be taking it from here in our next class. I think we are in which slide now? 1 minute. So slide 14, please remind me in the next class, slide 14. We'll be taking it from slide 14 in our next class. So please, let's ensure that we do the right thing. This is a very, very crucial topic, as well as other ones that we have taken before. Review your process very well. Familiarize yourself with the relevant provision of the standards, and ensure that there are controls in place before you take any engagement. The discussion we have had is not only limited to audit and non-audit service alone. There are some audit engagement you could want to take, and when you look at the risks of taking that very engagement, if you don't have sufficient measures to mitigate those risks, you will just have to do away from taking those risks. It's not a crime to telling a client that, oh, as much as you would love to take in that very engagement, but for reason beyond your control, you cannot take it. So please appraise, you don't make your decision entirely because of money, right? There are some engagements that the risks involved may be far, 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 far more than the money. So take note of that. And even beyond this very discussion, if you have any other thing you want us to rub minds on, let's engage me. I'll be very much available to having that discussion with you. I wish you all the very best. I hope you'll be able to make the best of what we have discussed. And I wish you a very pleasant week ahead. Good night, everyone.
Good night, sir.
Good night, sir. Thank you.
Thank you very much. Good night, sir.
God bless you, sir. Thank you.
Good night, sir.
Thank you, sir.
Pardon?